Hey everyone, it's Laura Zink with the Reynolds team at Compass. If you're wanting to know where mortgage rates are heading, stay tuned to learn more. The top indicator if you want to know where mortgage rates are heading. Mortgage rates have increased significantly since the beginning of the year. Each Thursday, Freddie Mac releases its primary mortgage market survey. According to the latest survey, the average 30-year fixed-rate mortgage has risen from 3.22% at the start of the year to 3.55% as of last week. This is important to note because any increase in mortgage rates changes what a purchaser could afford. Giving you an idea of how rising mortgage rates impact your purchasing power, here's a chart for you to review. How can you know where mortgage rates are headed? While it's always difficult to know exactly where mortgage rates will go, a great indicator of where they may head is by looking at a 50-year history of the 10-year Treasury Yield, and then following its path. Understanding the mechanics of the Treasury Yield isn't as important as knowing that there is a correlation between how it moves and how mortgage rates follow. Here's a graph showing that relationship over the last 50 years. This correlation has continued into the new year. The Treasury Yield has started to climb and it's driven rates up. As of last Thursday, the Treasury Yield was 1.81%. That's 1.74 below the mortgage rate reported the same day at 3.55, and is very close to the average spread we see between the two numbers. Average spread is 1.7. Where will the Treasury Yield head in the future? With this information in mind, a 10-year Treasury Yield forecast would be a good indicator of where mortgage rates may be headed. The Wall Street Journal just surveyed a panel of over 75 academic, business, and financial economists, asking them to forecast the Treasury Yield over the next few years. The consensus was that experts project the Treasury to yield the climb up to 2.84% by the end of 2024, based on a 50-year history of following this yield that would likely put mortgage rates at about 4.5% in 3 years. While the correlation between the 30-year fixed mortgage rate and the 10-year Treasury yield is clear in the data shown above for the past 50 years, it shouldn't be used as an exact indicator. They're both hard to forecast, especially in this unprecedented economic time driven by a global pandemic. Yet, understanding the relationship can help you get an idea of where rates might be going. It appears, based on information we have now, that mortgage rates will continue to rise over the next few years. If that's the case, your best bet is to purchase a home sooner rather than later, if you're able. Bottom line, forecasting mortgage rates is very difficult. Chief economist at First America once said, the fallacy of economic forecasting is don't ever try and forecast interest rates, or more specifically, if you're a real estate economics, mortgage rates, because you will always invariably be wrong. However, if you're either a first-time home buyer or a current home owner, thinking of moving into a home that better fits your changing needs, understanding what's happening and what the 10-year Treasury Yield and mortgage rates can help you make a more informed decision on the timing of your purchase. Again, this is Laura with the Reynolds team. I look forward to hearing from you.